Good evening, viewers, and welcome to IR Talks. Today, I'll talk about the recent move in the US 10-year interest rates, or the Treasury yields as we call them. Last week, we saw the US 10-year Treasury being briefly bid at 5% mark. Today, as we talk, it's been trading just over the 5% handle. First time since 2007, almost 16 years. One of the key reasons last week for the 10-year Treasury to hit the 5% mark was led by a very strong retail sales number that came at 0.7% as against the Dow Jones estimate of 0.3%. Coupled with Mr. J. Powell's comments that inflation is still too high. Besides retail sales data, other US economic indicators like the US ISM manufacturing, ISM non-manufacturing and PMI continue to come in at or around 50 mark, a number that separates contraction and expansion. As for inflation, the core PCE or the personal consumption and expenditure number, while trending lower, continues to sit well above the Fed's 2% target. In terms of the headline number, the headline CPI, which has been trending lower until June, has again started moving slightly higher, much for the discomfort of Fed and the broader markets. While the recent Fed speak and comments from a couple of hawkish Fed members suggest there could be a pause in the Fed's next week's meeting on October 31st and November 1st, a data print for US GDP for quarter 3 could complicate matters. The GDP data is scheduled to be released on October 26, and forecasts are suggesting it could come in at 4% or higher annualized growth rate for quarter 3. And if the number does come as per projections, Fed will have a tough time navigating the markets just before its next week's policy meet. However, we are seeing some pockets of distress in the US economy, with more subprime auto borrowers falling behind their scheduled repayments at 6.1%, the highest number since 1994. We are also seeing increasing US bankruptcies, which, still well below the pre-pandemic levels, have seen their highest annual rate of increase since 2010 as of June this year. So as we expect another rate hike from the Fed and rates to remain higher for longer, as an investor, staying away from the riskier high yield segment of the markets and investing in quality investment grade debt will be prudent. In the current environment, with an opportunity to lock in higher rates, it would also be advisable to invest aligning those investments with certain long-term goals. For example, paying for your kids' education, or certain short-term goals like purchasing a property over the next 1 or 2 years. Indeed, look at these investments more as held to maturity rather than look at any trading gains which could possibly come over the next few years. And as is advisable for any fixed income investor, look at constructing a laddered portfolio, that is, maturity staggered across different maturity profiles, unless you're sure as to when the interest rates will start bottoming out and start rising again. As for equities, keep focus on quality. We do have the US big tech earnings coming in this week. Though on an equity front, with the current interest rate backdrop, geopolitical turmoil, don't be surprised if we do see further pullbacks from the current market levels. For more such details, please subscribe to my channel, press the like and the bell button, and you'll keep hearing from me. Until the next one, happy long-term investing.